There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blickery going to be along in a moment to get you up to speed on the action from today's session. I'm going to start with the major averages here. The Dow finishing just in the green, up about 31 points today, about 0.1%. We should mention as well, and I forgot to mention earlier, that today is a so-called triple witching day. That means the expiration of futures and options contracts. You tend to see some increased volatility. You also tend to see some increased volume, particularly on the open and on the close. So that could be playing into a little bit of what perhaps we are seeing here and this turnaround that we've got in today's session. Because guess what? The S&P 500 also just at the closing bell here, kind of going into the green, up about 0.1% there as well. And the NASDAQ also, which had been sort of playing between gains and losses all day, finishing the day higher by about 0.5%. Not necessarily any fundamental news, headlines crossing in the last half hour of trading to push things higher, but perhaps more the technicals of what we've been seeing going on with witching here today. And a lot of folks still digesting the Fed, still looking ahead to April 2nd and what's coming next on tariffs as they try to figure out what to do in this market. Now let's get over to Jared for a closer look at today's action.
Thank you, Julie. Well, let's see if this photo finish turned into gains for the week, because that was not the case this morning that we would have these gains. So I'll put a 5-day look on here, and you can see NASDAQ Composite in the green for 17 basis points, just barely, but that counts. So that snaps a 4-week losing streak, excuse me. So this is the first in 5 that is in the green. Same for the S&P 500, and we'll take a look at the NASDAQ 100 as well. That is in the green as well. So snapping a down streak there. Let's check out the Russell 2000. That's also in the green for about 0.5%. And just taking a look at volatility, we dipped below 20 yesterday, kind of rose above it a little bit in the morning, but we're finishing the week under 20. And that's just kind of a psychological level that traders look at. 10-year T-note yield, that was down 2 basis points. Not a lot to look at there. So we will move on to the heat maps, and let's take a look at the sector action. We see 3 in the green here. They're all the mega cap sectors: communication services, consumer discretionary, and tech, but not in the green by a lot. Materials, the biggest laggard, basically tied with real estate there. Energy, which should be the winner this week, down 0.7%. And let's check on the 5-day totals. Indeed, energy finishing the week up 3.1%, and it's the best sector gainer of the year as well. And what we're seeing here, materials, utilities, and staples, and tech, basically that's flat as well. Those were flat to down this week, but not by a lot. Let's take a look at the NASDAQ 100. This is the 5-day look. I want to take a look at what's happening today. And we can see Tesla up about 5.5%, NVIDIA down 0.7%. And let's take a look at some of our leaders as well. We can see ARK Innovation Fund among the leaders, that finished up 3% today. KWeb, China, which has done well this year, but not today, that finished in last place. And let's just take a look at some of those ARK components, a little bit of a deeper dive. Tesla, we already covered that. Shopify up 2%, Roblox up over 5%, Roku up over 6%. So tech pulling out a decent day to end the week here. So I think things are kind of better than feared. We did have this rally that began last Friday. We're actually on day 6 of that. And it's not much of a rally so far, but we'll see if it has some legs next week. Josh?
All right, Jared. The S&P 500 just able to snap a 4-week losing streak, and despite the recent declines, our next guest says this is a buying opportunity and that the bull market is not over. Joining us now is Julian Emanuel, Evercore ISI Senior Managing Director, Equity Derivatives and Quantitative Strategy. Julian, always great to see you and to have you on the show. So let's start right there, Julian. You say you've got confidence. This bull market, it's not over. This current correction, it's a buying opportunity. What gives you that confidence, Julian? Walk us through it.
Well, first of all, in talking with clients and looking at the data and thinking about how people are positioned, the sentiment can best be described as abjectly miserable. Okay. And frankly, when you look at how markets trade, when pessimism is rampant as it is, when the data, the soft data, the attitudinal data has deteriorated, but the hard data, the actual on-the-ground economic data, is still holding in, small cracks, but still holding in. In our mind, all of this adds up to the potential for the bull market not being over, this being a buying opportunity. And frankly, today's action was much more positive than I think any of us could have hoped, looking at the way the day started.
Well, and Julian, to your point about the soft and the hard data, there's been so much discussion about that recently. Jay Powell, the Fed chair, of course, talked about it this week. He says the survey data, the confidence data, doesn't always translate into spending, right? It doesn't always mean what people say and what they do can sometimes be two different things. That said, when you're looking at the hard data and we're only seeing cracks, what would you see that would get you more concerned there? What are you watching most closely?
Julie, the thing that has been and continues to be the most important is the labor market. And we put a lot of stock into that high frequency Thursday at 8:30 a.m. New York time jobless claims data. And it has stayed very steady in the low 200,000s. To us, the real test is going to be over the next 4 to 6 weeks when the DOGE cuts certainly hit the public sector. What's the bleed over into the private sector jobs data? And we're all holding our breath, but it is our opinion that while it's going to certainly, set that data on a bit of a higher course, we don't think that you're going to have a situation where you're likely to see abject negativity, which we would define by weekly claims exceeding 300,000, which tells you that a downturn would be right around the corner. It's not going to be nearly that severe in our view.
So Julian, so there's so many viewers who are watching right now, and let's say, what is your advice to those viewers? They want to stay invested. They want to stay invested in this environment. At the same time, we're in an environment where we have these headlines constant, a lot of drama, a lot of noise, a lot of emotion. How do you try to stay focused and look through that?
So actually, I believe there was a movie that's being released this week called Tune Out the Noise, about index funds and the development of that strategy over time. And we would encourage investors to tune out the noise as much as is humanly possible. And it is difficult, granted, and certainly for a professional investor, you really can't do it. But the fact is that the long-term trend for equities in our mind continues to be positive, driven by the idea that you aren't likely to have a recession this year, and you are likely to have earnings that are sort of on the order of 8 to 9% growth year over year. And you have a Fed that is not going to hike rates under any circumstance and is more likely to cut rates. All of that means stay invested. And if the day-to-day volatility is too much, we would suggest rotating towards stocks that we call it our all-weather outperformers, stocks across industries that are likely to have solid enough fundamentals at attractive enough valuations after this sell-off that they're likely to do well, whatever the range of uncertainty is the next 12 months.
Of course, Julian, you're also aware that a lot of investors have been looking outside of the U.S. for the first time in a long time, right? And I was struck by a chart that Joe Weisenthal of Bloomberg posted today where he looked at the ratio of U.S. stocks to the rest of the world as measured by a couple of ETFs. And U.S. stocks have just been incredibly dominant for the last, call it, decade and a half. Until recently, where that ratio has kind of reversed and directionally gone a little bit the other way, where there's been some rotation. Are you also looking at that kind of trade, or do you still want to be all in on the U.S.?
We are looking, and frankly, the conversations that we've had recently really do lead us to believe that you are potentially on the cusp of what we would call a multi-quarter, perhaps even a multi-year point of rest of the world outperformance. But there's two things to understand here. Number one, that is generally contingent on a peak in the US dollar. And we actually do see that developing simply because when you look at interest rate differentials between the rest of the world and the United States, they're compressing. A lot of that as a function of the fact that Germany now all of a sudden has to spend a lot more to rearm itself. So you're seeing interest rate yield differentials collapse and compress. You're seeing the dollar really come off its peaks. That's very good for rest of the world stocks. Now, is this a time to just go out hand over fist and buy those and sell U.S.? It isn't. Okay. People have been underweight the rest of the world for a long time. We'd say address that underweight. But importantly, you have a weaker dollar, you have the AI story, and you have sentiment so negative in the US that it is likely a time, again, that the US, even if it ends up on a year or two basis, underperforming the rest of the world, it will likely rise as well.
Julian, I just want to get your thoughts quickly about gold as well. It looks like it retreated here. Spot bullion fell about 1%. Still up for the week, though. It's climbed about 15% this year. What is the message, Julian, the metal is telling investors?
It's actually a very mixed message. What's interesting about this run in commodities is gold has gone above 3,000 to the ounce, clearly being backstopped by demand by global central banks and sovereign wealth funds. China has been a buyer very frequently. It's a diversification play, given the uncertainty that we have geopolitically. Look, it's one of those things that if it makes you sleep better, it should be a tiny part of your portfolio. But again, from our point of view, the best asset to own long run with regard to inflation, with regard to actually paying real dividends, are equities.
Sticking with equities here. Julian, always great to see you. Thanks very much.
Thank you. Have a great weekend.
You too. Coming up, we're taking a closer look at the simmering tensions with China on both the economic and geopolitical fronts. We'll get expert insight on what to expect from the Trump administration. More market domination over time coming up.
Tesla endorsements from President Trump and Secretary of Commerce Howard Lutnick raising some eyebrows as shares of Tesla have tumbled more than 30% this year. Yahoo Finance's Rick Newman joins us now with more. Rick.
Hey guys, so finally somebody got around to pointing out that for the Commerce Secretary to go on TV and basically make a stock recommendation, I mean, that's a blatant violation of government ethics rules. Public officials are not supposed to take any position on commercial products, whether they say buy it, sell it, whether it's a stock, some kind of goods or product. I mean, you just don't do that. So I guess Trump has so normalized unorthodox behavior that not too many people even noticed that happened this week. But a broader question is like, is this actually going to help Tesla? And I don't think so. I think these efforts by Trump and his officials to try to help get people to go out and buy Teslas and maybe pop the stock a little bit. I mean, this just looks like desperation, and it makes sense because for most of its history, Tesla automobiles, they are electric cars that emit no pollution. I mean, these appealed mostly to Democrats and liberals and environmentalists who are now boycotting the brand. So Trump is trying to get who else is going to buy Teslas if all the environmentalists now hate Elon Musk because he's so hard in with Doge and with the Trump administration? Are Trump supporters now going to listen to Donald Trump and Howard Lutnick and say, oh, wow, maybe it's time for me to buy Tesla or to buy an electric vehicle? I mean, I don't think so. So, this debate is going to go on for a long time. How does Tesla kind of revive itself? The most obvious way would be for Elon Musk to say goodbye to the Doge Commission and go back to running Tesla. But I don't think that's going to happen. So this is going to be quite an interesting case study in what happens when a CEO goes phenomenally political at some point. It hurts the company directly.
Rick, as you say that, I mean, as somebody who's covered politics for a while, has that happened before? Do we have any kind of playbook for this?
So, not that I can think of, and I encourage anybody who knows to let me know. Back up for a minute. I mean, many CEOs have political views, and there have always been CEOs who supported one party or another, always angling to become Treasury Secretary or whatever it might be, Commerce Secretary, Labor Secretary. There's nothing new about that. What's new with Elon Musk is that he has gone from he says that he used to vote Democrat mostly between like 2010 and 2020. During COVID, he clearly began to develop libertarian views, and now he's really becoming kind of an authoritarian. He's just going into the government single-handedly and trying to bend these agencies to his will. So I cannot think of a time when a business person, especially an active business person, I mean, think of Hank Paulson, when he came in from Goldman to be the Treasury Secretary under George W. Bush. He was done at Goldman. He wasn't still, running Goldman Sachs, or he wasn't planning to go back to Goldman Sachs. He didn't. So a lot of these people, once they turn political, that's sort of how they burnish their career toward the end. Obviously not what Elon Musk is doing here. So to my mind, this is a unique situation with a radicalized CEO who's still trying to run a company and get regular consumers to buy his products.
Rick, thank you. Have a good weekend.
Hi, guys.
China's imports of U.S. cotton, cars, and some energy products all plunged in the first 2 months of the year after President Donald Trump started imposing tariffs and Beijing retaliated. The measures the U.S. and China have imposed on each other over the past 6 weeks and the probability of more to come in the months ahead are creating huge uncertainty and raising costs for businesses. Joining us now is Bob Davis, author of Broken Engagement and former Wall Street Journal senior editor. Thanks so much for joining us. So there's a lot of uncertainty out there. Bringing your vast reporting experience to bear here, what would you observe we can know at this point in terms of the relationship between the two and how this might evolve?
Well, I mean, I think you've already seen. I mean, Trump has put a number of tariffs on China, and I think come April 2nd, when he says he's going to introduce his what he calls reciprocal tariffs, you'll see a lot more. But I think one of the main differences this time compared to Trump 1 is it's not just targeting China. It's targeting basically any country with a persistent trade surplus with the United States. I mean, this is raw Trump. This is Trump, as he's been for decades. In Trump 1, I think he was enormously influenced by some of the hawkish advisors that he has. I mean, he was hawkish also on China, don't get me wrong. But the singular, focus on China, which was indicated in Trump 1, I don't see that this time around. This time around, it's much more broad-based.
Bob, I'm curious, we've had some investors come on, some strategists, they're focused on China, and they have this kind of optimistic view, Bob. They'll say, listen, they ultimately think a deal is going to get done between Trump and Xi, that you're going to see a grand bargain between the U.S. and China. I'm curious, Bob, whether you share that optimism, and if there was kind of a grand bargain, a big deal that got done here, what would be the outlines of such a deal as you might see it?
Yeah, I think there'll be a deal of some sort or other. I mean, Trump clearly, obviously, likes deals, thinks of himself as a deal maker. Xi Jinping wants to reduce as much pressure as he can from the United States. But remember, in the first Trump administration, again, they had a deal, right? The phase 1 deal, China didn't live up to it particularly. The Biden administration didn't really try to enforce it, but the tariffs stayed in place. I think what you're seeing is what economists have warned about for decades, that once you put tariffs in place, they're hard to remove. So I don't see Trump, eliminating tariffs on a large scale as a result of, any kind of deal. He might hold off on some tariffs that he was thinking about. Remember, in the campaign, he talked about 60% tariffs on China. We're only up to 20%. So maybe it won't get up to the 60% mark. But I think, what a broad deal would be something about fentanyl, be certainly lots on Chinese purchases of U.S. goods, might even be, some encouragement of Chinese investment in the U.S. But I don't think, and there may be some talk about, reforming China's economic policies, but I think that's Xi Jinping's bottom line. His bottom line is to keep China the way it is and not to make the kind of concessions on economic policy that U.S. Policymakers have been urging for decades.
Bob, I want to ask you about the role of Elon Musk in the U.S.-China relationship as well, because there were reports today he was at the Pentagon this morning. Musk is, that is. And initially, reports said he was having a briefing on China and sort of the U.S.'s military strategy toward that country. The administration pushed back and said, no, that's not what it's about. But regardless, he clearly is at the center of a lot of stuff right now. He has a big business in China. Do you think there's any chance that he would mitigate Trump's approach to that country?
I presume he would be arguing for, a more accommodationist kind of moderate approach to China, given his stake in China via Tesla. But remember also, I mean, he has, SpaceX, and SpaceX competes with China. So it's not so clear what his view on China is. He has multiple, interests, that conflict with one another. I mean, one thing to remember also is that Musk has also talked about Taiwan as essentially a province of China, and that he compared Taiwan to the U.S. versus Hawaii. I mean, that is something that if you're in Taiwan, you ought to be really quite concerned about, because I think Trump also doesn't say it that way, but has a similar kind of view. So I think the Taiwan issue is one that will be very different than what it was in either Trump 1 or in the Biden administration as well.
Bob, I'm curious, as we hit China, how hard could they hit back? And how exactly, Bob, could they hit back, specifically in our tech sector?
Oh, there are so many ways they could hit back. I mean, just think about delaying iPhone shipments, during a holiday season. There are just endless, levers the Chinese can push. But I think what holds them back from, using what they can do is that they're worried enormously about their economy, right? I mean, their economy is not doing very well, and they depend greatly on foreign investment. And if they were to act against big American companies, I think that would also frighten off foreign investment from other countries. I mean, if you're Samsung and you see China batting around Apple, do you think to yourself, oh, this is great, here's a moment we can pick up market share? Or do you think, geez, we could be next? And I think it's the latter. And I think the Chinese are quite aware of that. So that would temper, I think, any response that the Chinese have. But if they want to, my God, they can make life miserable for so many American companies and put on tariffs that would, would enormously affect, the inflation rate in the United States and how people think about, their ability to buy things.
Bob, in your book, you had a number of conversations with people in past administrations, officials who had grappled with the China relationship. What do you think was the best lesson that any of them shared with you that maybe this administration could take away?
The overall lesson was the difficulty of engaging with China. What do you want from China? Deciding for the administration what it really wants. I mean, administrations would come in saying they're going to be tough on China. It wasn't only Trump. I mean, George W. Bush came in talking about China as a competitor, but then got sidetracked, understandably, by the global financial crisis. Obama also had some, tough words about China, but he was still dealing with the financial crisis, plus wanted China's help on climate. So I guess the overall lesson is to think specifically, what is it that you want from China, and how do you try to accomplish it, and how do you get allies on your side to try to accomplish it? Because to the degree you can affect China's the way China acts, it is much more effective if you have allies working with you, because then they can see that the harm isn't only from the United States, but is from Europe, from Japan, from Australia, from many other countries that China cares a lot about.
Bob, great to have you on the show today. Thanks so much for joining us.
Thank you.
All right, time now for what to watch next week. Starting out on the housing front, monthly new home sales data for February is coming out on Tuesday. Economists forecasting sales to increase to 680,000. This is coming after a busy week of housing data, with mortgage rates rising again yesterday for a second straight week, and home builder sentiment falling to its lowest level since August.
Moving over to earnings, it's another big week of reporting from names like KB Home, Dollar Tree, and Lululemon. Lululemon announcing results for the fourth quarter on Thursday after the close, and analysts anticipate strong sales in fourth quarter, driven by better product choices during a strong holiday shopping season.
And finally, we're going to get the Fed's preferred inflation gauge on Friday. That's personal consumption expenditures or PCE. Economists expecting that both total and core PCE for February will hold steady at 0.3% on a month-over-month basis. It's coming after the Fed held interest rates steady this week at March's FOMC meeting.
Well, that'll do it for today's Market Domination Overtime. Be sure to come back on Monday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's asking for a trend. Stay tuned.